Hi, everyone. My name is Brad Renard. Thank you very much for joining me on this webinar. Right now it's January 10th, and the objective of this presentation is to really look at the broad stock market. And we'll look at the details of the market, the technicals, the sentiment, the fundamentals, and we'll give you our projections of where this market's going to go over the next 3 to 6 months. So here's the agenda. I'll give you an overview of my background. I'll give you a quick overview of MCTO and our products. And then I'll dig into the broad market analysis and projections, again, looking at technicals, macroeconomic data, sentiment. Okay, my background. So I am the managing director and chief publisher of the IC1 strategy. IC1 stands for the Iron Condor 1 strategy. So that's the product I've been running for about 12 years. I traded stocks since 1987, traded options since 1999, launched monthly cash-through options for retail traders in 2005. I'm launching MCTO Capital Management this year, and that's for institutional investors. I have 14 years of experience with credit spreads and iron condors, and that's the main strategy that I've been trading other people's money on, and that's called the IC1 strategy. I'm also editor-in-chief of the MCTO letter, and that's been published since 2009. My education, I have a BS in physics, BS in electrical engineering from Columbia University. I have an MBA from the University of Chicago Booth School of Business. And my corporate experience is mostly in high tech. I was 25 years in high tech in the Bay Area, the San Francisco Bay Area, in lots of different positions in engineering, marketing, and sales. I did 3 years right out of engineering school. My first job was in New Jersey, and I was at the GE Aerospace division. And so I was a design engineer in the communications group. I was at 19 years in electronic design automation software, and that's software used by chip designers to design microprocessors, memories, video chips, things like that. So that was my primary industry. After I was at GE Space Division, then I went back to business school, moved out to the Bay Area, and then I was in mostly electronic design automation software. I did jump into internet infrastructure, and I did that, co-founded a company, ran sales and marketing, and did that for 3 years, but found out that EDA was a better industry to be in. Also, I lived in Japan for 2 years running a branch office, so that was kind of interesting. Overview of MCTO. So we have multiple products. IC1 is the one that I manage. I'm the chief publisher. It's an income-generating, non-directional strategy. I sell far out of the money, 85% probability calls and puts on the SPX and the RUT indices. SPX is the S&P 500 index. RUT is the Russell 2000 small cap index. My trades expire in 2 weeks. These are all 2-week in duration trades. I use weekly options and I avoid the monthly options. This has a 12-year track record, and it finished off 2017 up 52%, and that includes all commissions and reserve cash. So the service did very well. DAC1, Directional Alpha Collection, we call it DAC1. Chief publisher is Pranav Singh. He does shorter term 3 to 15 day in duration, long, short, directional trades on stocks. 3% of the cash is allocated to each trade. He holds 15 to 25 positions open at any one time. He finished off 2017, he was up 33%, which includes commissions. Time decay, TD1, and chief publisher is Amir Atabaki. It's also an income-generating non-directional strategy, similar to IC1, but he does it a little differently. So he sells far out of the money, 85 to 90% probability spreads on the same indices, but his are expiring in 30 to 60 days, sometimes 90 days, and then he closes them early and cycles them to book the profit, and he wants 40 to 60% of the profit. He'll get out of the trade and then open up a new one. And coming soon, sector rotation. We buy in-the-money calls on stocks and ETFs within sectors that were out of favor, but now that sector is recovering. So you always hear by the talking heads and on TV and CNBC about sector rotation and how money is moving from one sector to another sector to another sector. Well, it's very true. And we have a lot of algorithmic trading services, funds that will move money from energy and into commodities or out of industrials or into financials, and it just kind of rotates around. And so we follow that money, and then we start moving into sectors that are starting to recover, and we'll buy the best stocks within those sectors. And this strategy also includes country ETFs. So we can be diversified across Germany, for example, France, China, Japan, Singapore, different countries, Vietnam. We have a couple newsletters, the MCTO letter. I'm the chief publisher of that. It's robust technical sentiment, macroeconomic market analysis, and this can really help all traders to time their entries and exits, really regardless of their preferred strategies. That's delivered each Sunday or Monday. It's been in continuous publication since 2005. Trade of the day, and that's Pranav Singh. And what he does is from the DAC 1 service, he'll select 3 trades weekly, and then he'll send that off to the TOTD subscribers. So these are the folks that are self-managed, and they just want the newsletter to come each week, Monday, Wednesday, Friday, to get trades. Again, DAC 1, these are 3 to 15 day in duration, long, short, directional trades on stocks, where he buys calls and puts. Okay, let's dig into the market and what it's been doing. Right now it's January 10th, and we'll just kind of look at everything that's been going on. We can see that this market's been going straight up. And this is a big deal. We're really repricing for a tax cut. And the tax cut happened. It added about $7, $8 worth of earnings to the S&P 500 earnings. And I'll show you on my projections based on earnings. But because earnings are improving, they're growing. Analysts are expecting earnings to grow about 10% this quarter for Q1 of 2018. Now that's an annualized number, but overall, they're expecting earnings to grow about 10% for the entire year. And that's a lot. Stocks will usually go up when earnings are growing and top line revenue is growing. This is the SPX, represents the S&P 500 index. We can see the 200-day SMA, the 100-day EMA. EMA is exponential moving average, SMA is simple moving average. So these are just moving averages. 50-day EMA, 20-day EMA. When a stock is over its 20-day EMA and keeps on finding support on its 20-day EMA, that is very bullish, and they're all upward sloping. So, wow, this is a very strong market. We're up to about 2775, 2780 now, but very strong market. Here's the rut. We can see that the rut broke up through 1452, popped up, pulled back, found support on the 50, very quickly retested this breakout level, slingshotted higher. So money is definitely flowing into the small caps. Supposedly a lot of the small caps will gain a lot from the corporate tax cut that Trump and team moved from, and Congress moved from 35% down to 21%. So this will allow the companies to generate more income, more earnings, and the stocks are repricing. We only get tax reform once every 20, 30 years. So it's a pretty big deal to automatically, magically create extra earnings for these companies. So that's why we're going up and going higher. Here's the NASDAQ composite. And now this is a weekly. So what I'm looking at here is it tells me if the stock market is in a confirmed long-term uptrend. When the 17-week EMA is above the 43-week EMA, then we're still in a long-term confirmed uptrend. These are weekly bars right here, these candlesticks. So each candlestick represents 1 week of trade. And you can see that we've been in a long-term confirmed uptrend since mid-2016, and especially when we took out a new high right here. And that's just about when Trump won the election, and then the market started taking off. So that was in anticipation of all the pro-business initiatives that Trump was running on, and especially when the House and the Senate and the White House were all Republicans under Republican power, then no surprise that this market was going higher. Volatility, we can see that the volatility, this is the VIX. This represents forward 30-day volatility, implied volatility for the S&P 500 index, and we can see that it's just very low, meaning there's not a lot of fear, and stocks usually will go higher when you see the 50-day below the 200-day, and I show a 13-day EMA. So we're still in very low volatility. How expensive is this market? Looking at earnings, expected S&P 500 forward 4-quarter earnings is $150. This is from FactSet Earnings Insight. You can actually go to Google, type in FactSet Earnings Insight, and you can see this report that comes up. It's a PDF. Google actually updates it pretty fast. You can get the most up-to-date report. It comes out weekly, and there's a lot of information in there. Now, this $150 already includes that extra $7-ish, $8 of earnings from the corporate tax cut. So it's now a reality. To figure out where the market's going, we would take that $150 of earnings, multiply it by a multiple. Right now, with sentiment being so strong, it's probably reasonable to project that this market is going to go up to a 20 multiple. It's called multiple expansion, where people are willing to pay more and more for stocks. So right now we're probably going to be moving up to 20 times earnings as a multiple. 20 times 150 is 3,000. So the SPX is probably going to hit 3,000 sometime this year. And my thought is that we're going to have my SPX target is 2,800 by mid-May. That's an incremental gain of 2%, and SPX target of 3,000 by the end of the year. That's an incremental gain of 9–10%. Could we go higher? We could, but we're at 20 times earnings now. That's a 20 times multiple. That's getting pretty expensive. That's a very expensive market. Can markets get more expensive? Yes, they can. Just a data point for you, we hit 21 times earnings in 1999, actually in March of 2000. So at 21 times earnings, that was pretty much the end of the very, very long 1990s bull market, and Reagan and tax cuts and a lot of spending on military, on aerospace and defense. And the stock market was in a very strong bull market in the 90s. 1999 was about the end of it, and that was in 2000, it ended, and that was the dot-com crash, and we ended up at 21 times earnings, and then the whole market was cut in half. So right now we're probably shooting for 20 times earnings, and we'll see what happens over the next 6 months. Risk-reward characteristics of holding long stock is definitely less attractive, just based on how expensive the market is. So money managers have been rotating some of their cash into Europe, Asia, emerging markets. US stocks are considered expensive. And it's probably to get more expensive. And the market, seasonality-wise, the market usually goes higher through April, the first 2 weeks of May. And I just wouldn't be surprised once we hit May, and we're probably already at 2850 in May. We're probably going to go past this target here at 2800. My gosh, I wouldn't be surprised if we hit 3,000 by May. But then, so everyone just piled in, pushed the market up, already hit our target, year-end target. I think then we could get pretty choppy if we go up that fast. Okay, let's start looking at some of the data that I watch each week. Now, these are basically all the charts that I just pull out of my analysis I do each week. This is in the MCTO letter. It's also in the IC1 advisory that I send out every Sunday, Monday. And I have to look at these charts each week. I can't really do my job until I look at about 80 charts a week, just to give me an idea of where we are with the market and where we're going. XLI Industrials, this is a leading indicator. I just want to know what's going on with the industrials. And we can see it's in a confirmed uptrend, still looking good. Technology, it's usually a leading indicator. Money still flowing into the sector, looks good. XLK. IYT, transports, rail, truck and air, anything that transports goods around the world, or especially around the United States, gives us a major leading indicator about the health of the U.S. economy. It looks good. It's in a confirmed uptrend. Took out some new highs. KBE, excuse me, KBE, these are the banks. We want the financials to be participating, and they're looking good. So the banks look good. Semiconductors, stocks, leading indicator, technology. Semiconductors go into just about everything. That's why a lot of analysts just like to watch the semiconductor industry, the sector, and make sure it's in a confirmed uptrend. And it is, looks good. It's been going up for almost a year and a half. This was a very nice long play here. Okay, breadth, market breadth. I look at about 30 market breadth indicators and charts, and this is kind of just a summary. I just took a few that I look at. I get most of these out of stockcharts.com, and you can actually get into stockcharts.com for free. And you can actually type these in, and you can get different breadth indicators. So this one, for example, is the percent of NASDAQ composite stocks that are above the 50-day moving average. If a stock is over its 50-day moving average, it's usually classified as healthy. So right now for the NASDAQ stocks, which is about 2,500 stocks in the NASDAQ composite, so it's a broad indicator of the overall market, it's a broad proxy of the market. 66% of the stocks right now are over the 50-day moving average. So overall, we're healthy. Looks good. NASDAQ composite cumulative advanced decline line. So this is on a daily basis, we look at the number of advancers minus the number of decliners on a daily basis of the 2,500 NASDAQ stocks. And then whatever resultant number we get, we just keep on adding that number each day to the value. So that's why it's called cumulative. And you can see that as we're climbing, it's telling you that we have more advancers than decliners literally on a daily basis here as the market kept on going up. Advanced decline line is very powerful, and it's one of the few leading indicators to watch. And whenever you see the advanced decline line, especially like a moving average on it, sloped upward, this market's going higher. Very high probability. So we just took out a higher high. This is for the NASDAQ composite. Things look good, at least for the next 2, 3, 4 weeks. Barring a shock, barring a geopolitical shock, those you can't predict. NYSE composite, advanced decline line again. This is cumulative. You can see that all the stocks within this index continue to take out higher highs. So that looks bullish. NAMO, this is the NASDAQ McClellan oscillator. This is also based off of advanced decline. It's just a little more short term, usually looking at a week. And whenever I see the 35-day EMA that I have on here as a moving average above zero, and if I see the actual indicator itself above zero, tells me we're most likely going higher over the next week or two. Okay, those were breadth indicators. Okay, let's look at around the world. Want to make sure that we have no shocks, potential shocks coming out of Asia, coming out of Europe, coming out of Japan. So here's Germany. Germany looks good, EWG. And this usually represents most of Europe. Germany is the largest economy in Europe, and whatever Germany is doing, most of the other charts look similar. Italy is also a pretty big economy, so I watch that one. France also, and France and Germany kind of track each other, so you could just literally just watch Germany. If this starts rolling over and breaking below the 50, or the 50 is rolling over and breaking below the 200, now that's not good. There's a pretty good chance that the US market's going to get hit within 30, 60, 90 days. So you have to be really careful in watching. Europe, China, same thing. We want to make sure it's healthy. It is. Just took out a new high. EEM, emerging markets, it's in a confirmed uptrend. This looks great. Japan took out a new high, multiple new highs. Overall, don't see any problems around the world right now. Okay, the macro data. I just show some of the things I look at, but this is most of it. Non-farm payrolls, that's the first Friday of each month. We've been bringing in new jobs every month, usually about 150,000 jobs. Things look good. And you can see here's the unemployment rate's has been dropping. We're down to 4.1%. So the economy continues to grow and we're still adding jobs. Now the quality of jobs is a different story, but that's a different conversation. But overall, we're adding 150,000 jobs, 130, 50, 180, almost 200,000 jobs a month. Retail sales look good. This is with us spending money within the United States, and it's usually, this drives 2/3 of the overall economy. So retail sales have been positive, it looks good. Consumer credit, revolving and non-revolving credit lines like car loans or credit cards. And in general, it's been excellent. It's been like 15 to 20 billion has been added every single month for years. I mean, this is just nonstop. So this consumer credit, the more people that have credit, more credit people have, the more they'll spend. The more they spend, the more they'll drive the economy. Seasonality. This is a picture of a seasonality. This is from Bespoke, which is a pretty good newsletter for market analysis. And so, for example, I see these little guys. Green represents, in the last 20 years, what did stocks do in October in the last 20 years? And for this says, in October, stocks were usually up 1.3% for the last 20 years. For the last 50 years, in October, stocks have been up on average 0.5%. And then for the last 100 years, for example, in November, stocks have been up about 0.5%. So you can see that October, November, December are very strong seasonality-wise. January is usually up also. February is usually flat. March is up. April is really up, and that's usually the strong month. And then that's usually the beginning of the end, where the summer tends to be pretty choppy and sloppy. So April, in the last 50 years, we can see that stocks have been up on average 2%. And for the last 20 years, in April, stocks have been up 2.5%. So very strong. So this is called seasonality. So right now we're in January, and these months tend to be the strongest. So if you want to make money long stocks, this is when you make it. And a lot of professionals or people who have been doing this a long time, they're out in May. They're just like, I'm out. I don't need to put too much effort into this, and I'll be back in October. Unemployment claims, people being fired from their jobs, has been continuously dropping. Looks good. ISM index, this is anything over 50 represents expanding manufacturing activity in the United States. Looks good. This is one economics house called the Conference Board of Leading Economic Indicators, and the LEI is what I watch, and it's a consolidation of like 7, 8, 9 different economic indicators. And it's been climbing ever since, ever since March of 2009, when the market finally started turning around and started heading higher. Core inflation. This is the PCE core inflation index, and this is what the Fed usually watches. And it's about 1.5%, 1.6%. Fed wants it a little higher, so they're going to stay dovish. They're going to keep interest rates. They'll probably push up interest rates 3 times next year, maybe 4, but they're going to take their time. Personal spending, this drives consumer spending, and this drives the overall economy. This looks good. It's been positive. Personal income, what people are making, it's really this orange line, and this is year over year, and it shows that it's climbing. Overall looks good. It's growing in that plus that 4% range. Housing market, it's been recovering ever since 2009. And we have starts and building permits. It's been climbing. Might be flattening out a little bit, but in general, housing market looks good. Okay, corporate earnings and revenue growth. This is the most important thing to follow. This is what ultimately dictates stock prices. And I mentioned $150 worth of earnings, and that's what this line represents. So this line, black line, represents forward 12-month earnings projection for the S&P 500 index, which represents 500 stocks. And right now, forward 4-quarter projections are about $150 worth of earnings. And if I remember what I showed in the last slide, we multiplied that by a 20 multiple, takes the SPX up to 3,000. And then the blue is the price of the S&P 500. And so you can see it's been climbing, and that is represented by this x-axis over here. So earnings, by the way, we went through our earnings recession, and this was really ugly. This market got really big, heavy. This was a big, heavy whipsawing market. Really tough to trade. And this market, up until Trump was elected president, this market was telling me that we were going into a recession. It was predicting that within 9 to 15 months we were going to be in a recession. So things were looking pretty ugly. And markets shook it off, companies shook it off, they started growing earnings again. And then we got animal spirits back with the Republicans back into, in control with their pro-business initiatives. So then I think it corresponded with companies getting their act together anyway, because they had to really buckle down because they were not generating earnings growth for about 5 quarters. We called that the earnings recession. And then when companies finally started figuring out how to make earnings grow, they started growing earnings, and overall, excellent. And then the stock market just started climbing. Okay, high yield bonds. What we care about with the high yield or corporate credit markets is there any credit stress? Right now, I don't like this. This doesn't look great, but I'm not too concerned yet. It needs to really, if we break below 86, then that's going to be a concern. It tells me that there's stress in the corporate credit markets. Right now, it looks okay. This is the US dollar, strength of the dollar, and the dollar has been kind of weak. I'm amazed. I mean, this dollar really should be stronger with how the US economy is growing and how the Fed's going to be raising interest rates. But also, it's been pushed down because Europe's been strong. And so some of that, I think a big chunk of that is from the euro being pretty strong, which has kept the dollar lower. Overall, a lower dollar is not that bad. I mean, it's good for large companies, and that's why the big caps have been climbing and the Dow Jones has been climbing, because when we have a weaker dollar, the goods and services from our large companies where we sell overseas, our goods and services are cheaper overseas when our dollar is weak or weaker. And then interest rates, right now we're been around 2.5, 2.4 for the longest time. Now we're ready to break up through 2.6%. Overall, it's good. It's just telling us that everyone's starting to agree, and the bonds market is agreeing that this economy is going to continue to grow. And it's probably going to be fine. We'll probably be fine. The whole stock market should be fine until we start hitting 3%. And that could happen this year. We'll see. And if it does, then that could slow the stock market down. But right now, everything looks fine. Okay, so all of that analysis boils down to some projections. And also, this is what I care about with my service, with the IC1 service, Iron Condor 1 service. I sell spreads, I sell calls and puts, 2-week in duration, and I care about support and resistance. I care about, if the market pulls back, what will hold as support, and when I sell calls, where should I be placing my calls? Now this is tough. You don't really want to be placing too many calls when this market's going straight up, but we are coming up to 2,800, which is a major level. So just recently, I started feeling more comfortable in opening a few calls, like selling 2805s, 2810s, 2800s, but they're still at risk. We have to be very careful, and we have to be prepared to move them really fast and flip them back to puts if they start getting hit, because this market's repricing. We don't have tax reform but once every 20, 30 years, and this market is not done repricing. I mean, we're going to be at 3,000 within the next 6 months, 9 months. Okay, prediction. High probability that the SPX will hold above 2,700 during a pullback. So that's just about right here. That's the breakout level, and that's also the 20-day EMA. So pretty good chance that we're going to be holding above 2,700, and reasonable chance we'll probably be holding above 2,740 during any pullback. if we even have one. We haven't had a pullback in a while. And target of 2,800 by mid-May. Might blow past that before we know it. Target of 3,000 by the end of the year. And you know, that'll put us around 20 times earnings, which is not cheap at all. Pretty expensive market, but I have a feeling we're getting up there. Okay, I think that is it. Here are my disclosures. And that is the end of the presentation. So we're going to do this each month, and the next one will be in February. We'll take a look at all the charts, take a look at the sentiment, take a look at, and sentiment, by the way, is kind of like breath. Breath charts actually give us a lot of information on sentiment and how bullish everyone is. And then, of course, the macros, we care about the macro data, care about all the economic data, care about what's going around the world, in China, in Japan, in Germany, in the UK. Everything looks fine right now. So we'll just take this week by week by week, and we'll watch. Right now, this market is continuing to go higher. And we could have some quick little pullbacks here and there, but everything seems to be bought. And so the minute that anything pulls back, the following day, everyone piles in and just keeps on pushing the market higher. So we'll probably again end up at 3,000 by the end of the year, and I'll give you an update in about 30 days with my new projections, and we'll kind of take it in 30 days from now to see where we are. Okay, thank you very much for your time, and you can go to our website if you need any more information on monthlycastyeroptions.com or support@monthlycastyeroptions.com. We always check that email, or we have a toll-free number. And we also have free trials on our products, so you can sign up for a free trial if you have interest. Okay, thank you very much and for your time, and I'll talk to you in about 30 days.